Hi, everyone. My name is Brian Page. I'm an attorney at Forster Bowman. We are located in Maitland, Florida. I'm an attorney that specializes in taxation, including cryptocurrency and how it's taxed, along with estate planning and international taxation. Today, we're here to learn about cryptocurrency. And so I'm going to explain what this is. We'll go through an agenda, and then we will get into the tax, and you'll have a primer of how it works and what to be thinking about when you interact with your clients. So this is Crypto 101 for CPAs. And so it's a taxation of Bitcoin and other cryptocurrencies. So let's get started. So here on our agenda today, you will see, first off, I will explain how blockchain works, what it is, from the perspective of, I think everybody now has heard of Bitcoin, but there's other things that are involved in blockchain. It's not just currency. And we'll go into the basics behind that and what it means. Then after that, we'll do an overview of cryptocurrency in general and go through some of the nuances and how they're different, how they're started, how they're mined, how they're stored, and then of course how they're disposed of or exchanged and what the taxation of that is. We will then get into the compliance from the perspective of the IRS, Treasury, FinCEN, your FBARs, all those things you need to be aware of if you have clients that have this type of asset. Now it'll be reported each year on the 1040, along with some of the things your clients need to be worried about as relates to what is being reported to the IRS. You have John Doe summons and things like that. We'll go through some forms you need to be aware of, and we'll go through some cases. They're always interesting. You can see what they've done thus far. And then lastly, we'll end up with any conclusions and then any questions that you may have and how to contact us to provide you with those answers. So without further ado, we will get started. So what is blockchain? Well, think of it sort of like the cloud. With Microsoft or Apple or anything like that, it's a database that is in the cloud that's not on a single leg place server, so it's decentralized, and it enables a ledger to be created and to maintain information. It can be for a type of money or currency. It can be for records or smart contracts, anything that way. And then of course it's maintained not in a centralized place. It's not a government, at least how it started. Now there's some governments starting to get into this. And then how actually it's just bits of information in a chain. Sort of think of the matrix in a way. And the initial ones were like 1 megabyte of information. Now they've expanded, but at least from the basic sense, something happens. These different machines around the world, they interact with each other. They solve the algorithm. And then at that point, whichever one wins gets a token or gets paid in some way. And then once that's done, it's the transaction occurs and it's there. It can't be erased and it's there. This chain stays in one step to the next. So if a person gets a piece of Bitcoin, you can trace it all the way back from where it started, theoretically. Now, we'll get into some things that some nefarious folks use to try to change that. But the idea being that it is a way to have information in a decentralized place, and you can exchange a value, basically. It has been utilized now for record keeping for deeds and stuff. There's some counties around the United States that have gone into that, but it's mostly for an asset that's exchanged in a type of currency that is virtual. So that's basically how it is. And the big thing is it's a public ledger. So anyone at any time can actually log on to a website and actually go see what it is. It's hard to understand at first, but you can kind of see what's going on. And it's anonymous in that you don't have a name necessarily associated with the currency itself, or the ledger itself. Now we will get into envelopes and personal and private keys and how that works, but that's, in a nutshell, that's really how it works. This started back in 2008 with Bitcoin, and the idea is they wanted to have a way to exchange value over borders without governments being involved, and no centralized banking location, so it couldn't be controlled or manipulated. That was sort of the idea, and so that's where we are today. It has gone a long way since it started. So here are some features in general. In this presentation, I'm going to use the term Bitcoin. It means basically any type of currency that exists. It can be Ethereum, a Ripple, Dogecoin, all these different ones now that exist. I mean, there's hundreds of thousands of them now. There's probably 20 to 50 now that are mainstream, but they're starting all the time. But all of these types of assets have these main general characteristics. One is it's decentralized, so there's no banking house, there's no Federal Reserve, there's no Eurobank, Deutsche Bank that's controlling what's going on. Because anytime you have a transaction between parties, you'll have an individual who has something that's going to be sold or disposed of, and you have someone who has money, and then they want to exchange. So unless you're handing over cash, which is obviously different, let's say you have a check, you have a clearinghouse, a bank that's in between. So this is trying to avoid the banks. So in this case, this blockchain is up in the cloud. You can access it all over the world, but you just can't go to one place and get rid of it. So it's decentralized. It's also, because it uses the technology that exists, crypto means hidden. It's a secured medium to where it can't be hacked. And even though you hear stories about how bad, nefarious individuals have come and they've taken things, Bitcoin itself and other blockchains, at least on the mainstream, have never been hacked. What have been hacked have been the exchanges or the wallets or the computers where the keys have been stored. They have been hacked. And then once an individual gets a hold of the asset and they transfer it, you can't trace it anymore. You don't know who did it, and it's gone. And then once it happens, if a mistake is made, they can't get it back. But the actual technology itself has not been hacked up to today. So that's like a really neat thing about it. As I said, there's no intermediaries, no central bank. I said a minute ago that once a transaction or a transfer has been made, even in error or it's been stolen, can't change it. It's gone. So positives and negatives. A lot of these things are great, but in the wrong hands, they can also be bad. It can be exchanged. It can be exchanged for goods, services, dollars, or other types of currencies that are virtual. It's not quite anonymous. It's a pseudonymous, which means, so for every individual, we'll use Bitcoin as an example, you have a private key, which is sort of like the access code to get into the bank, to get the value, and you have a public key, which is where if you wanted someone to send money to, you would have a indicator on the web, and that would be where they would direct the transfer. So they can trace where things go, but they don't know who actually owns the private key. So that's why it's pseudonymous in a way. So think of it like a postcard. You can see where the address is going. That's the public key. Maybe a better analogy would be like an envelope. You can see on the outside where the address is going, but you don't know the contents of what's in there, who it's addressed to. And that's really So governments are able to track it to an extent, but it's still very, very, very hard to find out who's doing what. And that's why it's gotten like very big in the on the dark web. You're able to do things for malware because they don't really know who's doing it, or if you have like a ransom for something. That's why it's, the governments don't like it, because they don't know what's going on. They also can't tax it. That's also why they don't like it. That's probably the main reason why they don't like it. So anyway, so they've got that. It does have a value, but again, it's only as good as what someone will exchange for it. Now, miners. What do miners do? Well, to have all this information, somebody or a computer has to solve these algorithms to set the blockchain, the information that says, here's the value, it went to this individual, they own it. So every time there's a transaction, the blockchain gets longer. Well, a miner is an individual that uses a computer to solve it. And if they solve the problem first, they get paid. So that's what a miner does. It takes a lot of electricity to do it, and that's one of the downsides to this type of technology, at least as of today. But the miners are the ones that solve the blockchain as it goes from one individual to another. They get paid. And then the last thing is, as I discussed, it's borderless and international. So there's a lot of things that you're able to do with it. So it's a really neat technology. And so we'll do some basic things here to explain how it works. First off, you have a wallet. We talked about this. That is how, so when you open I encourage you to go on your own and open a wallet on Bitcoin. Doesn't cost any money. Set one up, and you'll see what I'm talking about with a public and private key. Your public one is your address, and then your private key is sort of like your password, how you access the safe to exchange the value. Now, wallets. There's different ways to hold this information. Obviously, you have cold storage, you print it out, but understand if someone gets a hold of that, they can access the value and steal it. So you have to be very careful with that. Think of it like a bearer bond. Someone can just take it. A lot of individuals will store things on their desktop. I don't advise that, but that's what a lot of individuals do. If someone hacks in or steals it, they're able to get it, and once it's gone, it's gone. You can use the web and cloud. Again, Amazon, Microsoft, there's always a risk someone could take it, and if they do, they don't know who did it. A lot of people, they put on their phones. Same deal. And then others say, you know what, I'm afraid of everything, so I'm just going to keep it in my brain. The problem is if you forget it or you mess up, you can't access it again. We had a client 2 or 3 years ago that died. They had probably $500,000 worth of Bitcoin. They couldn't find the key. So until someone finds it, it's just going to be out there. The value can't be accessed. So that's the problem with this. If you lose it, it's gone forever. So that's kind of interesting. Now, how do you acquire these things? Now, things have changed over time. When you initially got Bitcoin, in the old days, it was peer-to-peer. If you're of my age, when I was in college a long time ago, 25 years ago, we had Napster, we had LimeWire, we would exchange music on the internet, and it was peer-to-peer. There was no exchange. You would just find an individual that had it. You had a way to interact with each other, and that's how you would exchange value. So I will pay you 1 Bitcoin for a pizza or something like that. That's how it used to be, and it's still there. It's less common now, but it's, there are some websites and marketplaces. Localbitcoins.com is one of them. That's one way. Now, the most common one now is an exchange. Think of like Gemini is a really large one now, but that's basically where you pay a fee for every transaction for them to host it, but they're kind of the intermediary to make sure that the person on the other side does what they're supposed to do. Think of like PayPal in a way. That's an exchange, and that's probably the most common one now that exists and that you will utilize if you want to acquire this type of asset. And then lastly, you have an initial coin offering now, sort of like an IPO, but for crypto. The SEC is getting involved now. It's not, it used to be the Wild West about 4 or 5 years ago. Now it's getting much more like regulated. And there's, different types. There's a token and things like that. But most individuals and clients that you will deal with most likely will be on an exchange. And we'll talk about that and the compliance that goes along with if you have an exchange, what you need to make sure now you report to the IRS every year, because the exchanges are going to be reporting the information to the IRS regardless. So make sure that your clients are aware of that. It's not as anonymous as it used to be. So this is how it works. Basic diagram. You log onto the website, or in this case, it can be the exchange. You put money into an account, US dollars. You get a wallet, and there's a fake key there. It kind of gives you an idea of what it looks like. You put money in there, so you have credit, then you can go acquire the currency and exchange it for value, and then you own it inside your wallet. That's how it works on a basic level. Once you have it, then it's a matter of how you dispose of it. You can either exchange it for other things, or you can go back to the exchange and someone can buy it there. So that's how it works. Now, what does that mean from a compliance perspective, and what does how does the government now, at least in the United States, how do they govern these things? Because obviously this is a new technology, the government's always behind, and so they have slowly developed a way to regulate it, which is the whole point of having it, is not to be regulated, but that's the nature of the beast. So on one side, after September 11th, with the Patriot Act, if you're doing bad things, Bitcoin and cryptocurrency is obviously a vehicle to do things on the dark web. And so to combat that, the Financial Crimes Enforcement Network, or FinCEN, issued regulations about what convertible virtual currency is. So it's defined, how it's regulated, and then at that point, the anti-money laundering laws apply. And so now if you own an exchange, or you're doing something you're not just an owner of something, but you're actually in the business of, or you host an exchange, you have to be a money servicer's business. So you're regulated at the federal level and potentially at the state level. Every state's different, but you need to be aware of that. If you're transmitting money, there are rules for that as well. So that means all of the customers you have to know your customer information. And of course, anti-money laundering laws apply. And then of course, if you're the intermediary, you can be liable. So all those things now are governed. What's interesting though is from this perspective, from the perspective of currency and regulation on the criminal side, they look at it like currency or other type of money, which is interesting. On the tax side, Treasury said, you know what? No, it's not currency, it's property. So all the rules that relate to the exchange of property or the disposition of, those rules apply and not currency. So you have a dichotomy between how it's done, which is one of the few assets you'll find where it's like this. So for certain things, it's considered like money, and for taxation, though, it's considered property, like stock or real estate or anything like that. So at every disposition, it's a taxable event. And that's why they did it. They want to make it as inconvenient as they can for you not to utilize this. So in 2014, the IRS issued its first guidance really on this type of asset. And you can find it IRS Notice 2014-21. That's where they define things. There's some questions and some answers there. And it basically governed everything along with the other laws as relates to the exchange of property for 5 or 6 years. And then in 2019, the IRS issued some more guidance with some FAQs, and you can go on the website and find it, and it goes through a lot of like scenarios. Okay, I have this fact pattern, what is the outcome? And the bottom line is it's property. When we first started this, we weren't sure how to track basis, because you're supposed to specifically track every time you exchange a thing or you acquire it and track basis. And so they tried to make it easier to understand and to report it and have compliance. So I would definitely like to direct you there. It's a decent sized document. There's 30 or 40 questions and answers. So I would, definitely take a look at that. So for this overview, though, here are some basic questions. One is, how does a taxpayer account for basis? 2, can we get like-kind exchange treatment? I think we know the answer to that now after the last update with the tax law in 2017, but there was an argument on that for a long time. Is it if it's in a wallet or if it's in an exchange offshore, is it subject to FBAR requirements as a foreign asset or facto? Is it, if you're in the business of exchanging it, is it a security or a commodity? Is it neither? And then, of course, if that's the case, does the SEC apply all the rules in the Howey test? Is it passive? If you're in the business, and then, if a person dies, is the asset subject to probate? Does it pass on death? Like, what does that mean? So we'll try to answer these here. So from the tax side perspective, there are a few ways to acquire basis, and these are the standard ones. One is cost. If you use US dollars, that's the easiest. You go on an exchange or you're peer-to-peer, you spend, I don't know, I guess what last time I looked at $16,000 for a Bitcoin. If you buy one Bitcoin, you have a cost basis. It's in your wallet. The date that you acquired it. Since it's treated like property, the tracking period is going to be from the date of acquisition. And then if you sell it after a year and a day, you'll get long-term, capital gain. If it's less than a year and a day or a year or less, and it's short-term. So that's easy. If it's transferred, so if it's received by gift, obviously you're going to have a transferor basis. Note, if the taxpayer can't substantiate basis, the IRS is going to say it's 0. So keep that in mind. Inheritance is pretty straightforward. Same rules, 1014 apply. Obviously, it would be date of death value or 6 months after death, assuming it's reported on a return, which is always a big if. And has the person who owned it been reporting to the IRS each year, which they've been doing for 2 years now. Exchange is pretty straightforward as well. If it's exchange for a good or a service, then it's the fair market value of that good or service is exchanged for the cash itself. And then obviously, if you mine it or you receive it for income, mining, it would be the fair market value of the asset when it's acquired based on the market. And then if you receive it for income, it's going to be the fair market value of the services provided. I would say we don't recommend that any client of yours that we have actually accept Bitcoin directly. We always advise them to get their clients to exchange it on their own. The paying clients who are hiring out the clients that we have, that the person who's buying the service exchange it themselves and then pay our clients that we advise cash. And the problem is that if you accept it, like if we as a lawyer accept it as payment, number one, the person who exchanged it, that's a taxable event for them. So they have to report that information. For us, we have a cost basis of the fair market value of which we received it for. That's taxable income to us. We have to report that then, and when we exchange it later or we use it for anything else, we're taxed again. So that's why we don't like to recommend that, because it's very cumbersome. And that's why the government, we believe, did it, is so it discourages the use of this as a medium of exchange. That's really the main reason why they did this logically. We talked about the holding period based on when it's acquired, and then obviously how you receive it. Either you do it yourself or you've acquired it through inheritance or by transfer. If it's a gift, you need to make sure you trace that, and then beware of the exception to the step up or step down rule. If someone gets something in contemplation of death. We've seen this, knowing that they're going to die. It's Bitcoin, because for long there went way up in value 3-4 years ago, and they were terminally ill. The idea being that they would get a date of death value. And of course, if it's within a year of death and contemplation of death, you don't get a step up. So just, be aware of that rule. I think that's it for that. What happens at disposition? We're going to go through some examples, because these are probably the ones you're going to see. It's really easy, but we want to make sure that you understand the nature. But basically, the common rule is it's treated like a disposition of property, so it's taxable at every transaction. So here are some examples. If you acquire, so if you have cryptocurrency yourself, or your client does, and you exchange it for US dollars, it's a taxable event. You have a amount realized, which is the US dollars. You'll have an adjustable basis, which is likely the cost basis or the acquired basis from however you ended up getting it. And then if it exceeds the cost basis, is taxable. If you use it for a good or a service, it's a taxable transaction for the individual who pays for it. If you exchange it for other, we know for sure now that it is taxable, because there's no like-kind exchange anymore except for investment or like real estate now. We know that now. So there was a debate before, but that's been solved. If you give it as a gift, not taxable. A wallet-to-wallet transfer amongst the person who owns it themselves, not taxable. And obviously, if you buy it with US dollars, that's post-tax dollars. That in and of itself is not taxable. However, when it's disposed of later, it'll be a taxable event. So essentially, anything other than buying, holding, or transferring is a taxable event. That's the basic rule. So the most common, you sell it for cash on an exchange, taxable. You use it for barter, which is very common now. These individuals on the internet now, they like to pay for things, artwork or like services or whatever, thinking that, hey, if I barter this, we're exchanging value, but the IRS won't know about it. It's not taxable. It is. So make sure your clients understand that it's a taxable event. And then exchange is easy as well. And there's no like-kind exchange. Those are the main rules. So, compliance. Our clients need to be aware if that they're in the business of accepting as payment, they will have Form 1099-K requirements. So make sure that you're aware of that. They're keeping them proper records, and that you've got the name, address, all that fun stuff that applies to that form. And they will give that to the IRS each year. So the person who is doing the exchanges. So your client who might not think, oh, the government's not going to know about this, these things are being reported now, and it's much harder now for the government not to find out, because they're getting these reports and they're matching. And it all goes back, and they use on the idea of know your customer. For these individuals to run these businesses with U.S. residents, they have to report this stuff to the IRS. And that goes into the John Doe summons. The IRS sued an offshore exchange. It went to federal court. Court ruled that yes, if you have U.S. residents and they have a wallet or offshore, and they have a certain amount of transactions or an aggregate value in an account there in the course of a year, even if it drops down, that exchange has to report the information to the IRS. And so, usually that's more than, I think the rules are 200 transactions totaling $20,000 in value. So it's not that much money. This information is being given to the IRS, and then they're matching it. So, and then now, as I think it was last year, on the form 1040, now there's actually a box you check if you acquire it, if you own it. So now you're reporting the IRS informationally, I have this asset from now on. If you fail to report it, there are penalties associated with that. So make sure your clients now are doing what they're supposed to be doing, and you're advising them, I have this form of asset. There's no taxes necessarily due, but you're letting the IRS know that they exist. You also have the fail-safe that these exchanges and other types of intermediaries are reporting this information to the IRS each year, and then they're matching. So it's sort of like a 1099 for any other type of income for a vendor, or so that's something that you need to be aware of. Now, because of the nature of the asset, courts from the very beginning have struggled with how to treat it. Is it property? Is it money? How is it going to be governed? And so one interesting case is the SEC versus Shavers. Now, the SEC sued the defendant for securities violations. The defendant, Mr. Shavers, he argued that Bitcoin was not money because the IRS said that it's property, because that's how it's taxed. And if it's good enough for the IRS, well, then it has to be the government ought to be bound by that ruling, that no, it's property. So the rules regarding the Securities and Exchange Commission don't apply because it's not considered currency or stock, or it's just property. Well, the court said, no, it's definitely a type of investment. And so in that case, it can be regulated by the SEC. Big shock. Anytime you have a bad actor, this is what normally happens. And of course, the government's always going to err on the side of regulation. So that's how they ruled. And the issue really is the treatment on the tax side of the gain or loss, right? Because then if they're saying it's sort of like an investment or a security, well, then you start getting into the loss rules. Is it a commodity? How is it governed? And so, if you think back to what the Howey test is, it goes through from the perspective of governing what a security actually is from the perspective of the federal government. It's interesting because this case actually took place here in Central Florida a while ago now, 80 years ago, but it had to do with orange groves and the ability to, they sold an investment. You bought a share in this, endeavor. And then the court went through these rules as relating to what you have to do, investment with purpose, people getting paid. And so that they ruled and it defined what a security is, and then how it ought to be governed and the rules behind that as relating to pro forma and disclosures. And that's kind of beyond the scope of taxation, but this type of asset is so unique, and you have all these rules which govern it. And so it's a pitfall to the clients because they think, no, okay, I know it's taxed this way, but from the perspective of other types of like regulation, it's different. And we see it a lot. Clients don't understand, or their advisors don't understand because it's so unique. You might know the tax rules, but you don't know these other rules as relates to FinCEN and the SEC, the Federal Trade Commission, all these different federal bodies, or the like futures as well. The other thing I think is the CTFC, or whatever it's called. Anyway, so that's, and of course, if it's a commodity, of course, you get into special like loss rules. So that's still kind of out there. We don't have a court case on that yet. We're still waiting, but that's something to keep an eye on. And slowly, these cases are starting to come through slowly, but we really don't have in certain areas actual guidance, beyond the FA, cues from the IRS. What is this? How is it done? We have a few like rev rulings as relates to a hard fork and a soft fork. We'll talk about that in a minute. But beyond that, beyond these basic, just you had the IRS notice in 2014, and then you've got the FAQ in 2019. There's no other guidance. There's zero. We just use by analogy property and how it's done. So the federal courts have explained from the perspective of traders that it's a mark-to-market accounting. That's how you should report it, and that's how the compliance of the accounts ought to be done. We know that now. The accounting method. We know before it was okay. It's not, even though it is fungible. They were saying no. It's like a piece of real estate or a stock. You need to know exactly when you acquired it, when not. Now you can, trace that if you use wallets the right way. We used to advise our clients in the old days. Every time you buy anything, create a new wallet. Then when you sell it, the exact date that it was bought, when it was sold. Really easy to track. We did that for a long time. Clients don't like that. They don't like to have 100 wallets. They just want one. So then the question was, could the taxpayer decide which cryptocurrency, or which, if it's a percentage of a Bitcoin or Ethereum or Ripple or whatever I sold? Because you might want one that has high basis or low basis, or vice versa. So there was a debate, and then so under the FAQ they decided it was LIFO. If you don't know for sure, but you can pick. But if you don't know for sure, that's how that they end up doing it. So you can read it there and understand it. But there was a debate about that for a long time, first in, first out, whatever it's going to be. Now it's been decided, and we know what to do. But now they have also come out and said that the taxpayer can pick which one is sold, as long as they can substantiate and track the basis. It works. So that's where we are today. Now, for currencies, what does that mean? Well, we do have a new revenue ruling. Well, I say new now, it's 2.5 years old, 3 years old, that if you're familiar with Bitcoin, there was a big hack on an exchange 6 or 8 years ago. It's called Mt. Gox, and a bunch of Bitcoin got stolen. It wasn't, the Bitcoin itself wasn't hacked, but the exchange was. And so they found a way to where they had their original Bitcoin, and they decided to have a separate one, Bitcoin Cash. So they split it. And if you already had Bitcoin, you also got some Bitcoin Cash, new cryptocurrency. So the idea is it forked. Bitcoin continued on the route that it had always been on, even with the stolen money, because you can't go back and claw it back. Then you had Bitcoin Cash, which is its new cryptocurrency. Okay, so what happens, right? When that happens, how do you allocate basis? Does it have value? Like, how do you trace that? Well, the revenue ruling came out and explained that if you have a airdrop of crypto, there's different ways to treat it. Either have a hard fork or a soft fork, and that really depends on how it's valued. And the revenue ruling goes through and explains, I'm not going to go through it, but it goes through and it explains, okay, under this fact pattern, it's taxable or not. And it's really, if you received actual value when you got it, then you have to report it income wise, then you have basis. If it's not income when you get it, there's zero basis. So when you sell it later, it's all a gain. That's really what it boils down to. Excuse me. Read it, understand it. If you have any questions about it, please feel free to email us. But I'm not going to like read it because it's very, very unique. And then lastly, there are some things here on the compliance side. We talked about the Know Your Customer forms. You also have now Know Your Business forms. So if you're accepting it as payment, or your clients are, they might be subjected to these rules with FinCEN, the Financial Crimes Enforcement Network. Even though it's all above board, doesn't matter. There's still some compliance things you need to be aware of, and also know your transactions forms. If there's somehow a closing agent or something, and this kind of stuff is flowing through an escrow account, you need to be careful because all these rules apply. And then lastly, from the perspective of penalties, this BitMEX case, it came out in 2021. There was an exchange that decided not to share information with the IRS, and it was very, very rude to the IRS. And so the court allowed them to issue big penalties on the business. And it's an interesting case. You get a chance to read it. It's called BitMEX. Kind of fascinating. So if your clients can trace the currency that's going to be sold, great. If they can't, we have an accounting method that they're able to use, and that's what you need to know to be able to solve when you report it on the form, how to track basis. Okay, now the Coinbase case. This is the case that established the authority of the IRS to get the 1099-K reporting with the information. Basically, the IRS said they can presume gains will be filed on the correct form. If they don't, they can go back to the exchange and get the information if they have an account there, if they're a US resident, to match. Of course, the Coinbase said, no, you can't do that. And the US court said, absolutely, you can, because they're US residents. And so now they have to report, and that's what's currently going on. And that basically boils down to where it's not as anonymous as it used to be, at least when you use an exchange, even if it's offshore. Now, the IRS has really pushed off in the last 2.5, 3 years, 2019, this idea of compliance. You can go on the IRS website. It goes through some of the things that the IRS has been doing to ensure compliance by the taxpayers in the United States, to make sure that they are informationally, one, reporting to the IRS if they acquire or own cryptocurrency each year. And then, of course, if there's an exchange or a disposition, they're reporting it and reporting the basis and paying any taxes due. Now, where do you report the gain or loss of this type of asset? Well, you report it on Form 89 to 49. Sales and other dispositions of capital assets. That's where you will report this information. And you will summarize it there like anything else. That's a capital asset on Schedule D. That's where it will be done. You also have a box that you will check saying that you own it, and or it was, you had a disposition in a given year. FBARs for FinCEN will also apply if it's offshore, and that's US v. Hom. Involved online accounts for gambling. Court ruled that they were digital constructs. Even though it's offshore, they're still treated as a foreign money. So that's why FBAR applies. So if you have a client that has something that's offshore, make sure they have more than $10,000. They're filing their FBARs like they're supposed to. And I'll have to explain to you how draconian the penalties are if you don't. So, and then FACTA, obviously, if it's a foreign asset and you meet certain thresholds, you're also having to report that as well. So make sure you're aware of that. There's the website for FinCEN that relates to these types of assets. They have some other like literature that you can go through and read and understand from the perspective of compliance, what your clients need to be aware of, and you can advise them, hey, you need to look at some more things. And then lastly, I always love the cases because, it kind of is where the rubber meets the road, because you have a new type of asset. How are the courts at both the federal level and the state level going? How will they treat these types of assets? And so the USB Fiala case, the defendant, which I believe was part of organized crime, they were doing an unlicensed money transmission business. They were laundering money. That's what that means. On the web, on the dark web, and they got caught. And when they got caught, the defendant was like, "You can't charge me with money laundering. Bitcoin's not money. It's a property, and you said you don't treat it as a currency. So how can I be, arrested and charged and convicted of, money laundering? It's not money." Well, court didn't buy it, and they said in this case, any form of payment is considered money, and so your conviction stands. That was the outcome. The bad actor, the court does the best it can. It did not want to give an avenue for people doing bad things, and so yes, the money laundering applies at the federal level. Now, at the state level, in our state, Florida, you have the state of Florida v. Espinoza, and it was the same deal. Charged with money laundering and drug stuff. He argued that no, since it was Bitcoin, it's not money. And actually, at the time, the state court, it ruled that, under a Florida law, it doesn't apply. So he actually got off for money laundering. So what happened? The state legislature the next year changed the law. So that doesn't work anymore, but it's kind of interesting that they use the IRS. This happened back in 2014 when the IRS notice had just come out. We didn't have as much regulation. So it's kind of interesting how it turned out, but it ended up being that the state updated the law, and so that no longer applies, but interesting nonetheless. And then lastly, my most exciting case is the Ulbricht case. I don't know if any of you can remember back in 2011, the Silk Road. It was a dark web website where all these bad actors from all over the world, terrorism, ransomware, kidnapping, arms deals, all these things were, they had an exchange called the Silk Road offshore. And so this guy, Ulbricht, he ran the website. Well, he got busted and charged being the owner / operator of this network. He was getting paid. He got a percentage of what was going through. That's how he made money. Was charged with money laundering, and he argued, of course, that it's not money. And he tried to argue that Bitcoin is a medium of exchange that may be exchanged for legal tender, therefore it's not currency, so the money laundering rules don't apply. Well, you can guess how the court ruled. Bad actor, can't have these folks doing this stuff. So they didn't buy it, and he wasn't convicted, and he's now in jail. But that's kind of the biggest case internationally as relates to this type of asset. So as a last review, tax is money. I'm sorry, tax is property. Every stage, taxable event, you report it on the 1040, 89 to 49, and if it's offshore, you have the FBARs and the FACTA to worry about. Those are the main rules. If you have any questions or concerns or anything else you might be interested in as relates to this, if you read any of the IRS information you find on the website, please feel free to contact us here at the firm. We advise clients all the time about how these types of assets are taxed, and also how they can be used in other types of planning on the asset protection side. Please feel free to give us a call. My information is there. And I hope you enjoyed today. Hope it was informative, and look forward to seeing you next time. Thank you.